Hey everyone, my name is Kobe Royse, and I'm a mortgage loan officer here at Paramount Residential Mortgage Group in Loveland, Ohio, a neighborhood here in Cincinnati. My job is helping people finance their homes who are not cash buyers with a loan through the mortgage process from start to finish. One thing I always like to start with is this. Buying a home is not nearly as complicated and intimidating as a lot of people may seem. As I like to say, life is easy, people make it hard. Most of the confusion people have comes from the misinformation they've heard from friends, family, or the internet. So what I want to do today is quickly walk through the basics of how the process actually works and what really matters and when it comes to getting approved for a mortgage. The first thing I'd like to address is probably the biggest myth in real estate, which is that you need 20% down and perfect credit to buy a house. That's simply not true. The majority of first-time home buyers are usually putting somewhere between 3 and 5% down. There's also down payment assistance programs available that can help reduce the amount of cash needed to buy a house. So if the idea of needing thousands of dollars saved up in order to buy a home has been holding you back, then maybe you're not actually as far away as you may think. When lenders look at pre-approving somebody for a mortgage, there's really only 3 main things that we're looking at. First one being your credit score, second one being your income, and third one being your assets. Credit shows your history of paying things back. It gives lender an idea of how you've handled debt in the past. You don't need perfect credit to buy a home, but generally speaking, the stronger your credit is, the better your interest rates are going to be, and the more options that are going to be available to you. Income is the second piece. Lenders want to make sure that your income supports the housing payment that you're wanting to qualify for. We look at things like employment history, stability, and your debt-to-income ratio, which is just simply a comparison of what your income is versus what your monthly liabilities are. And the third piece is your assets. This refers to the funds that are going to be needed for the down payment, closing costs, and reserves, otherwise known as your cash to close. That money can come from savings, gifts from family members or friends, employers, assistance programs, or sometimes even retirement accounts, depending on the situation. If those 3 areas, credit, income, and assets, are reasonably solid, then most people are actually much closer to buying a home than they think they are. And if you even are saying to yourselves, well, I got 2 of those fields that are very, very strong and one that's, maybe a little bit off, another golden rule of thumb in mortgages is that typically if 2 of them are very good, you can make up for the one that's lacking. Another thing I like to explain is the actual order of the home buying process, because a lot of buyers assume the first step is just jumping right on Zillow and shopping for homes online. In reality, the first step should always be getting pre-approved with a mortgage lender. The reason for that is simple. A pre-approval tells you exactly what you can afford, what your estimated monthly payment's going to look like, and what price range you should be shopping in. It also makes you a much stronger buyer when you go to make an offer on a home, because the seller knows that your finances have been reviewed and that the loan is likely to close. Once you officially have been pre-approved, the next step is working with a real estate agent to start looking at homes that fit your budget and goals. When you find the right house, your agent will help you submit an offer. If that offer is accepted by the seller, that's when your home officially will go under contract. Once you're under contract, several things happen behind the scenes. Typically, the buyer will have an inspection to make sure there are no major issues with the property. The lender will order an appraisal to confirm the value of the home is meeting the value of the loan. At the same time, the mortgage goes through the underwriting process where the lender reviews all the documentation to finalize the loan approval. After everything shakes out, you move to closing. Closing is the day you sign the final documents, the loan funds, and the home officially becomes yours. One of the biggest questions buyers have during this process is how much money they actually need to bring to closing. Generally speaking, the cash needed falls into 3 categories. That is, first, the down payment, which we talked about earlier. For many buyers, that's somewhere between 3 and 5% of the purchase price, depending on the loan program. The second category is closing costs. These are fees associated with processing the loan, title work, appraisal, and other transaction costs. Those typically fall somewhere around 2 to 3% of the purchase price. The third category is something called prepaids. These are items like homeowners insurance and property taxes that are set up in your escrow account when the loan starts. Good news is that many buyers don't actually pay all of this out of pocket. In many transactions, sellers contribute what are known as seller concessions that can help cover a portion of your cash to close. There's also assistance programs, which we mentioned earlier as well, that are designed to help first-time home buyers reduce the amount of cash required. Another thing buyers like to understand is what makes up to their monthly payment. Your mortgage payment is going to fall under 4 components: principal, interest, property taxes, and homeowners insurance. When we calculate your payment during the pre-approval process, we include all of those so you know exactly what you're getting into. Before I wrap up, I always like to mention a few common mistakes buyers should avoid once they start the process. One of the biggest ones is making major financial changes while you're in the middle of buying a home. Things like financing a new car, opening new credit cards, changing jobs, or moving large amounts of money between different accounts sometimes can create big issues during the loan process. The best rule of thumb is to keep everything financially stable from the time you get pre-approved until after you close. And if you have any doubts, ask your mortgage loan officer if anything you're about to do is going to affect your mortgage approval. The main takeaway I want everyone to leave with today is that buying a home is very achievable for a lot more people than they realize. The best first step is simply having a conversation and getting pre-approved so you know exactly where you stand. If you're thinking about buying a home in the next 3 to 12 months, I'd be happy to run some numbers for you, answer questions, and help you understand what your options look like. Thanks for taking the time to listen, and I hope this gave you a helpful overview of the home buying process.